Kind of what the video already hit on is an introduction to what type of retirement plan teachers' retirement system has. It is a pension plan, and I won't go too in depth with this because you already saw a lot of this on the video, but just keep in mind that the TRS benefit is a defined benefit pension plan. The difference between that and say a 401k is you're never going to run out of a benefit in retirement. It's a lifetime benefit. So no matter how long you live, over 100, doesn't matter. You're going to be paid that benefit every month for the rest of your life. Both you and your employer are contributing right now every month to our system to fund that. And it started on your first day of employment or membership. It is not based on your account balance, your benefit. When you go to retire, it's going to be based on a calculation of a few different factors. How many years you have in and what your average highest wage is. It's not going to be based on that balance. So you can look at your balance on your online account. It's also on your annual statement, but it's not going to give you any indication on what you're going to be receiving when you retire. That's where the estimate comes in handy. They're going to be paid to you or to your beneficiary, and also as a TRS member, you have survivor and disability benefits as well. We'll hit on those in more depth later on. In your TRS membership, the Montana Board of Investments takes care of all of the investment decisions. So unlike a 401k where you're deciding where to put that money and there's the risk, you are assuming the risk, we assume the risk instead. We're doing all the investments, or the board is rather, to make sure that we have a funded program for all the retirees once they retire for the rest of their lives. It is not a 401k plan, which again, you guys would assume the burden on that type of plan. And they are limited by your account balance. So if you have a 401k, it's a great supplemental plan, but eventually it's going to get down to zero. Well, this plan does not. This is going to pay you for the rest of your life. As a member with TRS, you do have some responsibilities. First and foremost, you need to let us know of any big life changes. Have you been married? Have you been divorced? Have you gotten a name change that we need to address? It's really good to make sure that you have all your information updated in the system. A great tool to do that is logging into your online account, which I'll be showing you more about that as well. You can change all that information right there. Another thing that we want you guys to make sure you do is review your annual statement of accounts. We just mailed those out in September. Did you guys receive that? Great. If you haven't, there is one available on your online account too, a copy of it. If you need it or you lost it, you can look there. But always take a look at that annual statement of account, and for a few things you want to be paying attention to. In the video it hit on a little bit that you want to be paying attention to how many years you have in the system. So make sure when you're looking at that annual statement you're checking out how many years we have you at. Until we can do a full review of your account, which happens closer to when you retire, we're reliant upon your employer to be reporting your wages and your status accurately to our system. So we want to make sure you have all the years that you're entitled to in the system, and the best way to do that is well before retirement if you can. If you see anything that looks goofy, like you say, okay, I've been a teacher for 20 years, but I'm only seeing 18, 19 in here, that's when you give us a call. Give me a call, and we can do a full review of your account and make sure that we have all of the service correct. And we're not worried about doing that when you go to retire, because that's going to be a busy time anyway. We don't want to mess around with that then. So just be paying attention to that annual statement, looking at those years of service and letting us know if anything looks weird on it. Make sure you are looking at that for beneficiary information and updating that if it needs to be right away. And I'll be hitting on that too again. It is really important to keep them up to date. Later in this presentation, I'll be talking about survivor benefits, and what those are is if you were to pass away as an active teacher, your beneficiaries are entitled to a benefit in that event. So it's really important to make sure that you have the latest and greatest folks as your beneficiaries. We've had situations come up before where we're having to pay benefits out to an ex-spouse because the person did not change it to a current spouse, or even just a child or something like that. And if that's the most recent beneficiary information, our hands are tied and there's nothing we can do about it. So definitely get out there, look at who your beneficiaries are. They're on your annual statement, I believe, but you can also look on your online account and you can update your beneficiaries there as well. The My TRS account, again, kind of hit on all of this. There's a bunch of stuff that you guys can do on there. You can update all of your contact information. You could look at your account balance, how much contributions you've made to it. If you've purchased any service, you'll see those out there as well. You can look at your most recent annual statement, and we have a great benefit estimator. If you're further out than 5 years, that's a great tool to play around with. And even if you're within 5 years, feel free to play around with that. It's the same system that we use to create your estimate, so it's no different. It allows you to kind of play around with different dates if you're looking at, oh, I might go in 3 years or 5 years. You can plug in different numbers in there, and it'll give you an example of what your benefit would be in any of those situations. And then, yeah, review and update your beneficiaries. Very important to do that. And that's a relatively new option. We've only been able to update beneficiaries probably in the last 2 years on that website. It makes it so much easier, though. Before then, you had to fill out a form and have it notarized. It was kind of a big deal. So definitely take advantage of updating those beneficiaries on your online account whenever you can. And this is just a snapshot of what our main page looks like, trs.mt.gov. Up in the upper right-hand corner is your member login. If you've never logged in before, it's going to take you through some prompts. Nothing different than setting up a login for anywhere else. It's going to ask for you to create a username and password, and then you're in. You're good to go and able to look at all that information and make sure that everything's up to date as well. All right, so let's talk about the retirement plan. So who here started teaching after or on 7/1/2013 or more recent? Is there anyone that's new enough? Okay, great, a couple? All right, so if you are someone that started prior to July 1st, 2013, you are considered a Tier 1 member. A Tier 1 member has different eligibility criteria versus a Tier 2. If you started teaching on or after 7/1/2013, you are a Tier 2 member in the system. A Tier 1 member, which most of the folks that are usually in these presentations, you're going to be a Tier 1 member. You have to have at least 5 years to be vested. Remember, you just have to have that 5 years in to be entitled to take a benefit. And you are eligible to take a full regular retirement benefit at either age 60, any age if you have 25 years of service in the system, and any age if you have service within 25 individual years. Now that's different than having a full 25 years. Let's say you've worked 25 years, but you've only worked part-time those 25 years. Technically, your service balance isn't going to be a full 25 years, right? It's going to be less than that. However, you would qualify for regular retirement, meaning a non-reduced benefit, if you have service within 25 individual years, even if it's part-time, okay? You do qualify for early retirement as long as you have at least 5 years in. You can take your benefit as early as age 50. It is going to be reduced if you are taking early retirement, and the reduction amount is going to be greater the further you are away from being eligible for regular retirement. So those some things to think on. A Tier 2 member, how it differs is, again, they just have to be vested and they can retire at age 60 with a regular retirement, or they can go at age 55 if they have at least 30 years of service in the system. They do not have the option of the 25 years of service. As a Tier 2 member, those folks can do an early retirement benefit at age 55. And another option you have when you go to retire is you can always withdraw your account balance instead of taking this lifetime benefit. Usually, it's not the best idea for you to do that, but we want to let you know of all your options. If you choose to do a withdrawal, you can take it as a lump sum, or you can roll it into an IRA or a 401k. It, of course, will forfeit your lifetime monthly benefit. And the only amount that you can take out in a withdrawal is the amount you've put in plus interest. The employer contributions don't go in a withdrawal. Those are actually going directly to our general fund to fund all the retirees when they go to retire. And so withdrawing, usually not the best option, but it is an option for you to do that if you want to. Purchasing service. So we'll talk a little bit, I won't talk in too in-depth on this topic because it really gets a little hairy because there's so many different types. But as a TRS member, you are able to purchase creditable service in a few circumstances. The common types are if you choose to do that withdrawal. Let's say you have 3 years in and you're like, I'm done teaching, I'm going to go off and do some other type of career. So you withdrew your account balance and then you find yourself teaching again. Now you're back in the system. You're able to repurchase that previously withdrawn service if you want to. So that's the first option. If you were in the military, if you were active duty in the military, You may qualify to purchase some of that time in, whether it was while you were teaching and you had to take a leave or prior to teaching even. So that's an option there. In-service leave is you could purchase time if you had a baby or were on FMLA for some reason. And a break in service, you're eligible if you just decided to leave and not teach for a couple of years. You can purchase up to 2 years of break time and put it into the system as long as you return after that. And really the most common ones that I deal with are out-of-state and private teaching service. If you worked out-of-state as a teacher or in a private school, you can purchase up to a maximum of 5 years of that type combined. So out-of-state and private, if you have both, you can only do 5 total, or 5 of one or 5 of the other. In those options, you are required to fully withdraw from whatever out-of-state retirement system that you're in. So you're forfeiting whatever you have in that other state to purchase just the maximum of 5. So this gets a little bit more complex. So if you have any of these types of scenarios and you think you may qualify or be interested in buying service, your next step would be to call me. And then I'd be able to kind of ask a few questions and see what you might qualify for and give you an idea on how much the cost is to buying that and adding it to your years of service. And that's what you'd be doing. Why would you want to buy service? Well, for a couple of reasons. Number one, you're going to get 25 sooner. Okay? So if you're a tier 1 and you have that 25-year service and you're not going to be age 60 when you have, that 25 in, you can purchase up to that amount. If you have 5 years out there to buy, that'll get you 5 years closer to that retirement eligibility. Or if you are already going to be 60 and you just want more years in, that's going to increase your benefit regardless. So any amount of service is going to be factored in that you're purchasing, and your end result is going to be a higher monthly benefit in retirement. Yes?
Does any foreign service count if it is accredited by the U.S.?
So it doesn't even need to be accredited. Good question. Her question is, I think, out of country?
Yeah.
Okay, so out of country teaching service, that also counts. Out of state means way out of state. It's anywhere in the world if you taught. The challenge with out of country is verifying it. So yeah, and a lot of times you get a letter from wherever you're going, or whatever service you did, and we'll take it. We're not really picky with those out of country situations. Only ran across them a couple times. Of course, they're not that common, but they follow the same rules as your out of state teaching. You can buy it for 5 years for that as well. Okay. What?
How much does it typically cost to buy a year?
And that is an impossible question to answer because there are factors. It's an actuarial calculation, and some of the factors that play into it are how many years you have and what your average, highest, or your last reported wages are, which can vary. I mean, everyone in this room is not going to have the same number. And so the best thing to do, if you were to call and you have that situation and you're interested in buying it, the first step is to have it verified. And we have a form that would have to be completed by your other employer, or get a letter for that out-of-country service. And then when we get that back, we put together your official quote on how much it would cost. Doesn't hurt at all to get that number. You can turn it down. You are not ever obligated to purchase that service. So call me is the answer to that question. I can't give you a ballpark because it varies way too much. Okay. Any other questions on purchasing service?
So you said it's based on your current salary or the average current salary maybe in the last 2 years. So it doesn't count salary that you were making in terms of wage.
Yes.
Okay.
Yes. So very good question, and that gives you kind of an idea. It's one of the factors. It doesn't mean that's how much it's going to cost us, what those wages were. But her question was, so it's going to not be relevant to what you were making out of state. It's going to be relevant to the most recently reported year of wages that you had in Montana. That's what we're going to be going off of. Okay? Yes?
So years and years and years. I heard you say that before. But to clarify, if I work at another educational institute, 9 years actually at my full-time job.
Could you repeat that? I'm not sure.
So I teach not only at high school, but also at collegiate level, who also contribute.
Yes.
Okay, so they contribute, but even if they skip a year or two in my collegiate, it really doesn't matter if I that back.
So it all depends on if you were getting credit, full credit for the years that you were in. You can never have more than 1 full year of service each year. So if you're doing a full-time position and you're doing this on the side like an adjunct or something like that, right? What it would do is, obviously your wages that are being reported are going to be higher, but you can only get a maximum of 1 full year for if you're in a full-time position. And so that's not going to add more service in doing that, and you wouldn't be able to buy it because you've already got 1 full year for that year in particular. Does that answer your question? Okay. Great. Anyone else? Questions on purchasing service? Okay. So really the biggest rule of thumb here is the earlier that you can get a hold of me to look into those options and see what they cost, the cheaper they're going to be. Oftentimes I'm retiring folks and they're like, oh yeah, I've got 3 years in California. How much is that going to cost? And they're doing the retirement paperwork with me, and I'm going, you know, usually that point, it is the amount, the cost is so high that it's going to take them 10 years into retirement to recoup what they would be getting. And, you know, with that payment that they have to pay to buy it. So definitely the earlier the better. You are, for out-of-state and private teaching service, once you reach your 5-year vesting period, anytime after that is when you would contact us, because that's when you're first eligible to purchase services after you get your 5 years in. Okay? And then also, I only hit on a few of the different types of service that you can buy. The most common ones are in this slide right here, but we do have a fact sheet out on trs.mt.gov that shows you all the options of service that you can buy. And they get a little bit, you know, less to come by, but that is a good reference tool. It'll tell you how many years you can buy of that type and what the type is comprised of, and you can see if you qualify for anything that way. Or if you're just interested in purchasing service, give me a call and I can ask you a few questions and we can narrow that down that way as well and see what we can do for you. You do, when you purchase service, have to have it tied to a specific situation. That's just one thing to keep in mind. Oftentimes I'll get calls from folks and they say, I just want to buy a year. And I'm like, I can't give you a year. I can't let you buy a year unless it's pertaining to one of these scenarios. We used to, back in the early 90s, we used to have an option to purchase for every 5 years you're in, you can buy 1 year. That's been no longer on the table since the early 90s. So that's not an option to just buy years outright. Have to have one of those circumstances. All right, so kind of referencing your handout in your packet, that is the timeline. We're going to start with 2 years out, 24 months. What you should be doing at this point is attending one of these presentations is a great start. Learning about the different benefit allowances, and we'll go into more depth with what those are in this presentation. You don't have to choose what one is now, but it's good to get, you know, an idea. Oh, this one is the one I think I'll do, and then, you know, you'll have, you know, at least an idea. You're not going into it blind and trying to figure it all out when you go to retire. It's also a good time to confirm with your employer if there is any requirements that they have on their side. So TRS doesn't have anything to do with your collective bargaining agreements. However, oftentimes payouts of your sick and vacation time are contingent upon you giving them enough notice. That's usually the most typical situation, is they want you to give them notice, say by like January 31st or something that's real common in there. Make sure you're also looking at that. If you're going to be retiring in your final year, make sure you're not missing any of those deadlines that might be on your CPA. Another thing you can do 2 years out is get an estimate of benefits, just a preliminary one. And again, there's bunches of ways you can get this estimate. That form in your packet's one. You can go on to your My TRS account and you can use our benefit estimator to plug in some info. Or you could just call me. I can gather info from you and then mail you out an estimate. Or you can make an appointment. I can meet with you one-on-one. We're based in Helena, so not too far. If you guys wanted to make the trek down, I visit a lot of people in the summer. They'll come over and make an appointment, and that's exactly what we're doing. We're putting together estimates and we're showing them all their options. There are certain things that we need to create an estimate, and you'll need them no matter which route you go. We need to know first and foremost what date or dates you're looking at retiring, so we can, you know, put you in right where that needs to be and kind of accurately predict what your years of service will be. We need to know what your current annual earnings are, so your contract amount for this year is what I'll be asking for. And if you're looking at years out in the future, I'll need to know what you want to anticipate for those future years. And then an estimate of your termination pay. And your termination pay, I'll talk more about this later in these slides, but essentially what it is your payout of your sick and vacation time, plus any qualifying incentives that your district offers. That number combined is your termination pay estimate. And in Missoula, Teresa Rollier in your payroll office is the one that can get that for you. Oftentimes you guys will call and you'll tell me you have 200 hours. And I have no way to calculate what the dollar amount is, but that's what we need to put your estimate together, is what your gross termination pay amount will be. So those are the things that I'll need, whether you call, or if you guys decide to go online, you'll be plugging in those numbers, or on that form, I think it asks for them right there. So yeah, just keep that in mind. If you need that info, make sure that you get that, and then follow up and you can get your estimate. It is not a commitment to retire, it's simply just giving you information. More fine-tuned to what we would be looking at as your benefit amount versus what your annual statement shows you. That's meant to just be a snapshot of where you're at now and makes a lot of assumptions on where you'll be at age 60. So not a lot of it is very accurate, it just gets close for you, but these estimates are going to be a little bit more fine-tuned to where you'll actually be. All right, so how we calculate your benefit, again, we've kind of talked already a bit about this, but it's going to be based on how many years you have in the system and your average final compensation. For tiers 1 and 2, it is your years of creditable service multiplied by your average final compensation, multiplied by 1.6667%, and that gives you your annual benefit amount. Divide by 12 and you've got your monthly benefit, okay? So it's a pretty simple calculation. It's nothing, really out there. The average final compensation is comprised, if you're tier 1, it's your highest 3 consecutive years of wages reported. Most typically it's the last 3, but not always. If you went, say you were a teacher, then went to principal, and then for the last few years you went back to teaching, we may be grabbing those principal years, because those might be the highest 3. It's wherever they are in everything that's been reported, and they're consecutive. For a tier 2 member, it's the highest 5 consecutive is the average that we're going to use for that. A tier 2 member also has a different category. After 30 years and age 60, it's called a professional retirement option, and they will be calculated, as you can see, at a little higher percentage. We're not going to see that for many years to come because those folks obviously didn't start until 2013. So we haven't had to do any of those and probably won't for quite a while to come, but that is one of the changes for a tier 2 member. Tier 1 member, you're always going to be that top calculation. The 110% cap rule. This rule comes into play. It is intended to prevent intentional salary spiking in your last 3 years. So if you did, you were just teaching at the lowest level you possibly can, and then in the last 3 years you decided to take on coaching and all these extracurricular, or even taking on a principal role or something that pays much higher. In that situation, per statute, TRS has to cap each year at 110% of the prior year. So if you're making over 10% more than what you made the prior year, and those happen to be your last 3 or 4 years in the calculation, we have to cap it at that 10% when we're looking at calculating your monthly benefit. So just something to be aware of. With a tier 1 member, again, it's the highest 3. We're going to be looking at that 4th year to make sure there isn't no more than a 110% cap of that 3rd year in that calculation. So wanted to make you guys, this is a new piece that we usually don't bring up in the slide, but it comes up all the time. It's not too frequent, but it can be, changing your monthly benefits. So you need to be aware that that is a rule that we have to abide by anytime that we're calculating the highest 3 or highest 5. Yes?
So the total is an opportunity to
Generally not enough. Generally that does not give you enough extra wages to be over that 10%. 10% above your prior year is pretty high. And the more common scenario that I run across is someone changing from a teacher to administration of some kind, something substantially higher. There is one exception to this cap rule. It is if you changed lanes on your salary matrix, and that created that over 10% increase. You do not need to worry about that. It is an exception, and you will not be held to that capping. Okay. Any other questions on this rule? So this is an example of someone that had to have that 110% cap applied. They're a tier 1 member, so we're looking at the highest 3. And you can see from that 2018 salary of the $65,889 to the 2019 salary of $79,666, that was greater than 110% of the prior year that we're looking back on, and we had to cap it at that 72,478, and then it's a rolling cap. So if there's additional, we have to cap it on top of the 72,478 at 10%. So just to give you an idea on how this usually looks. All right, so now we're 12 months out. Some of the things that we want you to look at is getting an updated termination pay estimate from your payroll office. And then you can use that to create another estimate of retirement benefits. What you're going to be doing at that point is really paying attention to your termination pay options, and I'll be going through those in these slides to come. And then do this before making any decisions and submitting any paperwork to TRS. And then also look at those retirement benefit allowances again and think about which one suits you the best. And we're going to hit on those later on as well. So let's talk about termination pay. I always tell folks that meet with me and they're pretty new to understanding everything to do with the retirement system. You have two big decisions that you're making when you go to retire. The first is, what are you going to do with that termination pay? And that's, again, your payout of your sick and vacation time and any qualifying incentives. That's your termination pay amount. As a TRS member, when you retire, you have an added option, a one-time contribution that you can make with that termination pay amount to increase your monthly benefit. Instead of taking it as a lump sum, you can use it as a contribution to increase your benefit instead. Termination pay, again, it is your payout of sick and vacation time. It is any incentives that your district may offer. Termination pay is not anything that's paid after retirement. It has to be paid at the time that you're retired. Amounts that are not wages, such as health insurance premiums, and then amounts that go to payable to you from a 457F or some type of different compensation plan. Those things are not included in termination pay. And one thing to hit on too is sometimes I'll see, it comes up more often than not that there's an incentive, but they'll split it where they pay a little bit right as you leave and then they pay another chunk 6 months later. I don't think Missoula does that, but I do have a couple of employers that do. In that event, only that first amount is considered termination pay because the other amount is not paid at the time of retirement. So just be aware of that. They all have to be, the amounts that are considered termination pay are all paid to you right at the end of your employment. It also cannot be wrapped up in other things, such as an option between taking a lump sum payment or insurance benefits. If it is either or situation, it is not considered termination pay, that cash amount. It has to only be a bulk amount of cash that you're offered as an incentive to be qualified for termination pay. Yes?
Sorry, I said one question. Do you ever see the termination pay going above the 110% cap? Is that ever?
So that doesn't apply at all.
It doesn't apply.
We're talking about a payout of sick and vacation time, and that's wages reported. And it doesn't work the same way. So termination pay is not reportable as wages to us. It's not going to be considered as part of your wages unless you're doing this investment, one of these investment options. Okay, so you have 3 different options with using your termination pay. With option 1, this is the way you put in the most you possibly can to get the highest increase possible. In this option, we're adding it to your AFC, your highest 3 years for Tier 1, highest 5 for highest 5 for Tier 2, to increase your average final compensation. So we split it 3 ways for a Tier 1 member to increase that average in your calculation. This option does give you the biggest increase, but it also has the highest cost, meaning you'd be putting all of that in, or the most you possibly can, I guess is how I'll put it. In that situation with option 1, you may have what we call an out-of-pocket expense if it is not enough to cover the funding of that increase for the rest of your lifetime, and I'll hit on that in just a minute. Option 2, in this one, we're taking your total termination pay amount and dividing it equally amongst all your years of wages reported. And in that option, you're only getting an increase, really a smaller one, for a smaller amount. You're not going to use all of your termination pay with option 2. You're only using a small amount of it to get a small increase, and then getting the cash back on whatever is not used in the system. Your district's just going to pay it out to you directly. Option 3, in that option, you're just taking the money and you're going to run. You're not putting anything in teachers' retirement system. It will be taxable, the entire amount, and will be considered wages on your taxes for that year. But yes, so that's the third option. You wouldn't get an increase, obviously, because you're not putting anything in. You're just going to take it as a bulk payment and do with it whatever you want. I can show you on estimate of benefits. That's where you would see if you fall in the category where you have an out-of-pocket expense. And I'll tell you kind of more. I have some examples here on where that comes up later on. How will termination pay affect your retirement benefit? So you decide if you're going to be doing either option 1 or option 2 by filling out what we call the termination pay irrevocable election form. That's form 129. It'll often be called the 90-day form. It is the biggest time-sensitive piece that you'll be dealing with your teacher's retirement. If you decide that you're going to be going with option 1 or option 2, that form needs to be completed greater than 90 days prior to your last day of work to be in effect. And what it allows us to do is lock in the option and then have that money come directly from your payroll, tax deferred. That's the big thing. And it's an IRS stipulation that we have to have it signed up that far in advance to have it be tax deferred option. If you don't get that form done, and you can still put in your termination pay with option 1 or option 2, but what will happen is your payroll office is going to pay you out your full termination pay amount with all the taxes out of it, and you would write TRS a check for the entire member cost of the option. So that typically means quite a bit of out of pocket if you're going to go with that option. So it's an important form. And while I say get it done, I also caution that don't do it until you pick up or complete an estimate of benefits and see what you're signing up for. Because you may have an out-of-pocket expense and you want to be prepared for that. You don't want to sign it blind, not knowing really what it's going to be doing in affecting you. So the rule of thumb is get an estimate of benefits first, and if you think, okay, I know what this is going to do to increase my benefit, then sign that 129 if you're going to go with option 1 or option 2. If you're just choosing to take the money as a lump sum with option 3, you don't need to do this form at all. You would just not do it at all. And then let us know in retirement that's your option to go with.
I have a question.
Yes.
That's zero hour payroll, correct? Activity teacher retirement system.
The form 129 is our form. Yes. Yep.
Can we get that form?
It goes with every estimate that we mail out. It is available, I believe, on our online forms, or you can call and request it. So, but really, we don't want it to go out to just generally everyone because we don't want them to sign up for it not knowing what they're signing. And we've had a few times come up where very helpful payroll people will have a stack and just hand it out to everyone and say, you have to do this now. And folks will do it, not realizing what they're signing up for, go to retire and go, wait a minute, what's this? Why are you putting the money in there instead of giving it to me? And then, oh, even worse, I have an out-of-pocket expense because I picked number 1, and then they don't even know that that was a thing. So get an estimate first and it'll go with it in the mail automatically. This is what the termination pay irrevocable election form looks like. It's a very simple form. You're filling in just your information. You're checking either termination pay option 1 or option 2. It does require a notary signature at the bottom. And then if you flip it over, it's got a signature place for your payroll office. So they also need to be in the loop so they know, they keep a copy so they know what to do with that payout whenever you go to retire. So they need to be in the loop on what to do. Because if you are electing option 1 or option 2, not only will it be taking that money to increase your benefit, but your employer also is on the hook to pay equal contributions or more actually at the same rate or greater. So they will have to know that they have to pay contributions on that too, which is why they're involved as well. Once you have it on file in our office, it cannot be changed. It is irrevocable. So that's why I always caution folks to get the estimate first. Because if you come back, you did it 5 or greater years from retirement and forget that you signed it or didn't even know why you signed that paper, we can't change it. We can't remove it from file. And so you definitely want to make sure you're not filling it out until you know which option you want to go with and what it means for signing up. So here's an example of out-of-pocket costs. So again, just one thing to keep in mind, the only time you may have an out-of-pocket cost is if you picked option 1, meaning that's putting the most in you can to get the highest increase. And this is different scenarios in which you may or may not have one. So we have our hypothetical employee here is retiring at age 60. He has in the first column 25 years, and then 30 years, and 35 years. So 3 different scenarios here. It's saying is termination gross amount of $5,000. Always FICA and Medicare will be withheld, so the net amount for all three scenarios is going to be $4,617.50. Now we've calculated a person in this scenario that has 25 years, the contributions due to TRS in an option 1 termination pay is $4,200. We would be getting that from that $4,617.50. So you can see in that scenario, we're not even going to use all of the termination pay. And in fact, whatever the difference is going to be paid directly from your employer to you. So whatever we're not going to pick up from that, they'll pay you the rest. And that's kind of the reverse of an out-of-pocket expense. And it's because it's really based on how many years you have in the system. Folks that have over 25 years will be able to get a higher increase in the calculation, but it also carries with it a higher cost, and that's where that out-of-pocket kind of comes into play. So in that scenario, 25 years, you can see that person was able to get an additional $57.87 more per month on their lifetime benefit. So that's the increase they're getting by putting that $4,200 of their termination pay in with option 1. The scenario where they have 30 years, you can see that the contributions due to TRS change to be $5,040, and the increase on the benefit jumps up to $69.44 more per month. So you get a higher increase on your benefit because you have more years of service in, but it carries with it a higher cost. In that scenario, we're only going to be able to get $4,617.50 from that termination pay directly. You would be responsible for the difference of the contributions due to TRS and the net amount that we would be able to get directly from your payroll office. That's your out-of-pocket expense if it is pertaining to you. Not everyone has them. Like I said, a good gauge is how many years you have in the system, but even that, it's going to be something on your own personalized estimate, which is not the same across the board. This is just a scenario, that we laid out, but you may have different factors at play. Obviously, the higher your termination pay amount is, the higher the out-of-pocket would be, if you even have an out-of-pocket. So some things to just take into consideration. In our 35 years, you can see it just increased from there. So the contributions due to TRS, $5,880, and you're in charge of paying whatever we're not going to get covered by that $4,617.50. So that comes out to $1,262.50. Okay? But at the same time, that person was able to get $81.02 on their increase on their lifetime benefit. So all the numbers just kind of do this. The more years of service you have in the system with that termination pay. Very complex topic. Does anyone have questions on that? Okay. So again, rule of thumb, get an estimate. It's going to show you what those different options are. Whether or not you have an out-of-pocket is going to be listed on there, and everyone's number is going to be different. All right, so now we're 6 months out. At this point is a great time to call us and request a retirement application packet if you haven't done so already. We generally will mail packets about 5 months prior to your last day of work. If you call me at the beginning of the school year, you're going to be done. That's a great period of time. I always tell folks that's a little more than 6 months out, but that allows you to give me the info I need to put together an estimate and get you on that mailing list. And then it'll automatically be mailed out to you, usually the end of February, beginning of March of the year you're going to be done. And so that's kind of the time frame that I usually tell folks to do. At that point, when you get your retirement packet and you're starting to fill it out, you're going to elect that retirement allowance, and I'll show you what the allowance options are. Once you start to receive your benefits, you can't make any changes on those allowance options at all. And well in advance of your retirement date, you're going to be completing all the sections of that form and then returning that packet back to our office within a month of your last day of work. That allows us enough time to get it processed. It's not a firm deadline. Nothing bad happens if you get it to us later. And people call me after they leave their position in the summer and say, I'm not coming back. I don't want to come back. And so I get it to them then. And anything you're entitled to, usually it's the month after you leave your position is when we're going to start your monthly benefit. And if you don't let me know for 6 months after that, we're going to give you, that retro payment to get you caught up and then start you on your benefits. So there's nothing really detrimental if you don't get it to us in time, but what it does is allow us enough time if there's anything missing in the packet to communicate with you to get what we need. And so it helps us a lot by getting it to us a month prior to your last day, just in case there's anything else that's needed with your packet. And at this point, it would be make sure of that option on your termination pay, that you're getting that termination pay irrevocable election form in. That's that 90-day form. So if you're 6 months out, you have a few months to get that into us after you've made your decision if you haven't already. So that's something to do at that point as well. So let's talk about benefit allowances. So I said you have two big decisions that you make on your retirement. The first is termination pay. What are you going to do with it? This is the second one. Which one of these allowances do you want to pick? And so regardless of which allowance you're going to be picking, it's going to be a benefit payable to you for the rest of your life, no matter what. Doesn't matter how old you are, you can, it's guaranteed to pay you for the rest of your life. Some benefit allowances provide an ongoing benefit to beneficiaries and some do not. So that's the difference. That's what you're deciding. Do I want to take a higher benefit and not worry about it going to anyone else when I die? Or do I want to take a little bit smaller benefit and guarantee that something will be payable to a beneficiary after I pass away? That's what allowances are. What you're picking from is those. So we'll talk about those. Your first option is your normal form monthly benefit. This is the highest benefit that you can elect for yourself, and it's the highest because it does not have any long-term benefit payable to a beneficiary after you die. It is basically you saying, I just want the highest amount I can get while I'm alive, and I'm not worried about going to anyone else after I pass away. Okay? So this is intended to pay only you. We also have period certain in life options. We have a 10-year certain and a 20-year certain option. What these pay, it pays the benefits for, let's say, okay, for the 10-year certain in life, it's going to pay for 10 years or your lifetime, whichever is longer. So one way to think of that, that's a little easier, is if you retire and you pick the 10-year certain, let's say you live 5 years into retirement and then pass away, your beneficiary is going to be paid out each month for those remaining 5 years of that 10-year period, whatever time remains. And then at that 10-year mark, it's going to be done. They won't receive anything else. So it's going to pay them out the remainder of that 10-year period. If you pick that option and live beyond 10 years, there's no benefit payable to a beneficiary. It's only the first 10 years, starting with when you start your benefit, that's going to be payable to them. And then we have a 20-year certain in life, same rules apply. It's just going to be out longer to 20 years. So let's say you pick that option and you live 15 years into retirement and then passed away. Your beneficiaries would receive that same benefit, but only for the remaining 5 years of that 20-year period. Okay. One thing that's kind of nice about these certain in life options is you can pick multiple beneficiaries and you can split things equally, or you can have a primary and a contingent. If the primary is still alive, they'll receive it, or if they've passed away and you have two, the contingent will receive any benefits. So it gives you a lot more freedom on who you can pick as a beneficiary, and you can list multiple primaries and it'll be split equally amongst them. So I see a lot of folks that are divorced with kids that they want to divide something up equally, pick options like this if it makes sense for them to do so. All right. And then we have our joint and survivorship annuity benefits. And these options, A, B, and C, they're pretty popular. These ones are designed to, after you pass away, pay for, or someone else takes over your monthly benefit for the rest of their life. And they are not contingent upon you dying at any certain time. You can pass away as long as that person's still alive. They'll receive your same benefit for the rest of their life. Option A is joint and full to joint annuity. In this option, when you pass away, they get your full retirement benefit you've been receiving for the rest of their life. Option B, they'll get half of your benefit for the rest of their life. And option C is 2/3 for the rest of their life. If you pick option A, that option is only available for a spouse. If you want to look at picking it with a child, you typically will have option B, maybe option C. It's all dependent on their age as it relates to your age, how far apart you are, because remember, we're trying to pay out someone else's expected lifetime as well. So it does make a difference on what options are available. If you pick a child, it also will severely decrease, well, not severely, but substantially decrease what you'll be receiving per month to compensate for someone else's much longer life expectancy. You could only pick one person. So her question is, it only works with one person. Yes. So these A, B, and C options, unlike that 10 and 20 certain where you can pick as many as you wanted, it's designed for one individual's lifetime in relation to yours after you've passed away. So you would only be able to pick one person with this option to have it go to. And then when they pass away, it's done, no matter what. They can't go to a third person from there. What else can I say? One thing that's kind of nice about these options is, well, what happens if your spouse passes before you and you picked option A? We have what's called a pop-up provision, where if you, in cases of death or divorce of your spouse or whoever you've listed for option A or B or C, if they pass before you, we're going to move you up automatically to the normal form high monthly benefit. And you have a period of time where you can change it to a different option with a different person or just decide to stay on the normal. So you're not locked into the lower monthly benefit with this option and no one to benefit it after you pass away. Okay. So it's kind of nice. You're not kind of kicking yourself for doing that. Sorry? Yeah, pop-up provision. So if you pick A, B, or C, and the joint annuitant or your beneficiary that you've picked to receive that after you've passed away, if they pass away before you, or if it's your spouse and you guys get divorced, we have what's called the pop-up provision, where we would move you up to the normal form high monthly benefit, that higher one that, remember, that doesn't pay anyone after you pass away. And you have a period of time where you can change your mind to a different option with a different person or decide to stay on that normal for the rest of your life. So it doesn't leave you locked into one of these options and not having anyone after you pass away to receive a benefit. It gives you the option again to pick someone else with a different option or go on a higher monthly benefit for the rest of your life. Yes? Sorry?
Your office automatically would do that?
So we do have another unit of our office that gathers, it's pretty morbid, information on people that have passed away, like announcements and things of that nature, and they must have access to vital statistics and stuff like that. And yeah, so they try to link it up. It helps if that situation comes up that you let us know and you send like a death certificate or something of that nature, but we eventually get to where we gather that info as well. Yeah. Any other questions? Okay. This is an example of an estimate of benefit. It's really hard to see. I'm sorry, it's tiny, but I wanted to give you kind of an idea on what an actual estimate looks like and some key things to be kind of paying attention to. There are the highest 3 years, and kind of the upper left-hand side, you can see what we're gathering to calculate your benefit. And then you have your credible years of service on the right-hand side. This one has 30 years in it. And then a termination pay amount up there of $5,000. In the estimate, you'll see 3 columns, and those are representing those 3 different termination pay options, option 1, 2, and 3. So you can see with option 1, for instance, if you followed all the way down, there is a your out-of-pocket expense, and that's where you're going to key in. If you have an out-of-pocket, that's where it's going to be listed. And then option 2 will show you the amount of the contribution. You can see it's significantly lower. With an option 2, you're putting in a small amount to get a small increase. That's that option. And then option 3 assumes nothing is being put in. You're just getting that $5,000 paid out to you directly. So you just have your monthly benefit amounts. And you see on the about middle of the page on the left-hand side, there's allowances. That's those different allowances I just went through. Your normal, your A, B, C, and then the 10 and 20 years certain in life. And you can see the different amounts that you would be looking at if you picked one of the different options in there. You can have an idea. One thing to kind of key in is this is, when you get an estimate, is these are gross benefit amounts. We can do after-tax estimates, so you can see what your take-home is, but these are prior to tax withholding. And your tax withholding is going to be on your federal and state only. With an annuity benefit, you are not having taxes come out for Medicare or Social Security. So, yep, just kind of talked about it being your gross monthly amount. They are taxable. You can change how you do your withholdings at your leisure when you decide to retire. We have forms in the packet that will let us know how you want us to withhold your federal and state taxes if you want to at all. There are options to opt out of that and just pay it at the end of the year like you would normally if you wanted to in a bulk amount to the IRS, or most folks opt to have us take it out just like your wages do today. But yeah, you can. What we would need to know is what your filing status is, either married or single, and then we would need to know how many allowances you wish to claim. The lower that number, the more taxes will be withheld. So 0 is the most withholding that we would do. You can always claim yourself as one. If you have any dependents, you can claim them as well as another additional number. And the more allowances you have, the less amount of taxes that we're going to be withholding, and that's pretty standard. You sign something fairly similar whenever you started working, so they know how much to withhold. You can adjust that at any time. We have forms available on our website to do that, and you don't have to wait for any certain period to change it. You can change it anytime you want to. But yeah, to start off with, we're going to be, having it in your packet. You'll let us know right off the bat what you want us to do there. Again, Medicare and Social Security taxes are not withheld. That's retirement benefit payments are not considered wages, and so they are not subject to those withholdings. There are some tools on the benefit estimator that can show you an after-tax estimate as well. So you don't necessarily have to ask me for that estimate. You can use that estimator tool, and there is a tax estimator too. So that's also available online. And after you retire, if you want to switch it up, you can go online and play around with that tool as well and see what you want to change it up to as well. So now we're 3 months out. At this point, we want to make sure that you've submitted all of your required application. Again, we like to get it at least a month prior to your last day, but if you get it done that early, great. It gives us tons of time to get it done. That's perfectly fine. You want to make sure you've submitted all the documentation that we are requesting. At this point, 3 months out, it is too late to do that Form 129. So hopefully you have that done in that, greater than 90 days prior. Any service purchases, so if you've worked out that you're going to buy a year of out of state, that has to be completed at this point as well. You need to have it, either you're forfeiting the rest of whatever's left of it, or you're going to pay the rest of it off. You can't purchase anything after retirement starts. And then you're going to be terminating all TRS reportable positions. So to be eligible to start a retirement benefit, you do have to terminate all positions that are reporting to us. So if you're a teacher and you're a coach, you have to terminate both of those. And otherwise, we aren't able to consider you retired. So again, terminate all employment with TRS reportable employers. If you are employed with more than one TRS reportable position, you have to make sure you do it both. And also, if you have multiple employers, sometimes we have someone working in Missoula as a full-time teacher, but they're doing something in a district not far away as a coach. You have to complete letters of resignation for all of those positions to be considered retired and able to start your benefits. All of your annual and sick leave balances must be paid, which they will be by your employer. And your effective date of retirement is going to be the first day of the month after your last day of work. And so I get this question a lot where folks are, well, my contract goes out to the end of June, but they're done in May. Some districts are done in May. I think you guys in Missoula are done in early June, somewhere around there, right? But they don't. So how we determine it is your actual last physical day at work is what we're going to be considered your date of termination, regardless of what your contract says. And we are going to start your monthly benefit the month following, whatever that date is. We pay our payroll on the last business day of the month. So if you are done in June, and that's your last physical day working, you're looking at your first monthly benefit the last business day of July. All right. So you attain officially a retired member status in our system when you receive your first monthly benefit. Up until you receive that first benefit, you can make any changes you want on your application. But once you receive that first benefit, it is set in stone from that point forward. You can't modify anything. And except for that pop-up provision that I talked about, there can't be any changes to beneficiaries or options whatsoever. And then one other thing is we have a kind of a cost of living increase. It's called the GABA, the Guaranteed Annual Benefit Adjustment. After 3 years of receiving your retirement benefit, 36 months, every January following, your benefit is going to increase 1.5% every January from that point forward. And there's no stop to it. It'll just keep going higher and higher. Every January, it's going to increase 1.5% for Tier 1 members. Tier 2 members, it can be anywhere from 0.5 to 1.5, depending on how the board puts it together. Okay?
Can I ask you a question, sir?
Yes.
Is there many teachers that retired and then coming back to substitute? And is it substituting also as TRS reportable?
It is. That's a really good question. So you're asking about kind of rules for working
Yeah.
after retirement. I'm coming to that slide.
Okay.
And all will be revealed, yes. Okay, general reminders. I'm not a financial advisor, So I can't help you make your decision. I can't say, okay, for you, this is what you should do. So we don't hold that liability at all. What we do is present you the information every which way we can to help you make that decision. So just keep in mind that if you meet with one of us, if you're talking to one of us on the phone, it's not our job to tell you what to do. That's something you guys have to figure out. But we are there to provide you all the info you need, hopefully, to make that your decision. And we do recommend you talk to your family about this. It's nothing worse than having a situation where we get a call saying, my wife passed away, and I believe I'm due some kind of benefit, and he hadn't talked to her about what that actual benefit was, and she ended up picking a normal form where he wouldn't receive anything. It happens. So always include your family, especially your beneficiaries, on what options you're picking, so they know what to expect if something were to happen, and there's no surprises. And they'll know then if they are actually entitled to a benefit, so they can let us know, as soon as they can, and we can get that going for them. So involve your family. Always good to talk to a financial advisor if you have one. Another one you want to talk to is a tax professional or tax advisor for any tax-related questions. We can advise it all on that as well. Oftentimes I'll get calls and they'll be like, how do I fill out the tax form? Well, I can tell you, what those fields are for, but I can't say, well, you're married, you have to put married down there. Or, you're just a single person, you put 0. I can't advise that at all. You're definitely wanting to talk to a tax preparer for anything related to taxes. Disability retirement. So as an active teacher, if something were to happen, you become disabled and you're not able to work anymore, we do have a disability retirement option. If you are active, invested, remember at least 5 years in the system, and a disability is preventing you from working in your position, you can apply for a disability retirement in this option, and it foregoes the age requirement and the 25-year requirement. So that's the benefit to doing a disability retirement is if you find yourself in that situation, you don't qualify for regular retirement, then you can lean on that. You're not able to work. The process is it would have to be, it's a packet that you fill out similar to the retirement packet, but it does involve medical information. It does require your doctors to complete the forms, which is pretty standard with a disability situation. And then when it comes back, it goes through our board. And our board meets on a quarterly basis, and they would review it as a group to determine if they have enough input to verify it and get that person started. It does not go hand in hand with a Social Security disability. We don't. If you're, that's completely separate. If you've been qualified for that, it does not translate to automatically qualifying for ours. It's a separate process. Okay, but just know that is available if something were to happen, and you find yourself in that situation. You can contact us, and we can get you what you need on that. Also, as an active member, you are entitled to survivor benefits. This is if you were to pass away as an active teacher. You haven't retired yet. You have a survivor benefit at play. If you are vested and have at least 5 years of service in the system, your designated beneficiary, whoever you have listed on your account as a primary, will have an option of either taking a lump sum withdrawal of your balance or taking a lifetime benefit. And it's going to be up to them totally what they want to do. We'll send them a letter and give them the options, and they return it letting us know which one they're going to go with, and that'll be that. If you are vested and you've worked in the last year prior to passing away, in addition to that option, TRS is also going to pay a one-time $500 death benefit to your designated beneficiaries. And then if you have any minor children under the age of 18, we'll also pay $200 a month for each of them up until their 18th birthday. And so those are some survivor benefits on top of that first one that I talked about. If you're in a situation where you're not vested, meaning you have less than 5 years in the system and this happens, you passed away, the only option is we're going to be funding out your balance to your beneficiary. There's no lifetime benefit associated with it because you were never vested in the system. Okay? So those are some safeguard things. Your account balance just doesn't go into a pot of money if this were to happen. There are pretty nice benefits available to your beneficiaries if something happens before you retire. So just keep that in mind. God forbid that were to happen. Okay, and now this goes back to your question about working after retirement. So I deal with a lot of these questions on a daily basis where we have folks that want to retire, but they want to still kind of come in and they want to do subbing, or they want to do, they just want to be a coach or something like that. So a couple things you have to keep in mind if you are a retired member. Before you start any positions, you must observe first a 150-day break in service. And during that first 150-day calendar break, you can't have any positions reportable to our system. So that is teaching, coaching, anything like that. There is one exception. We do allow up to 45 days of substitute teaching in that first 150-day break. And so because subs are so hard to come by, as I'm sure you guys all know, we want to make an allowance for that. We don't want to, if someone's retiring and they want to be a sub, do it. That's kind of how we're looking at it. So there is the first 150 calendar day break that you have to observe. Any other positions, there's a no-go. But you can sub up to that 45-day limit. And then beyond that 150-day break, you have an earnings limitation. And that is 1/3 of your average compensation, that one we use to calculate your benefit. You can make up to that 1/3 or the median, whichever is higher in the positions that report to our system, and still receive your benefit without any issues. The median right now is about $21,000, just to give you an idea. So if your average is higher than that, 1/3 of it, then we'll use whatever the third is of your average. But some things to keep in mind is it only pertains to positions that report to our system. So it's instructional positions in a public school system or university system that report to us. If you go into a completely separate position elsewhere that doesn't have anything to do with teaching, it won't affect your benefit whatsoever. If you wanted to be a full-time teacher out of state, it won't affect your benefit whatsoever. It's only things that report to the Montana teacher's retirement that you have to worry about. Okay? Did that answer your question?
Yeah.
Okay.
Question for you.
Yes.
I get calls a lot from people who say they can't find somebody to fill my position and I think I want to go back. What does that do with the 1/3
You bet.
of salary?
You bet. So her question was, oftentimes we'll have folks call and they'll be like, they try to fill my position and they can't find anyone and I have to go back and they're retired. We do have a third option that you could do as a retired member. Rather than keeping to that earnings limitation, you can go on what we call a second benefit retirement. And what that does is you're putting a hold on your retirement benefit and going back to work. And how it works is you would, just like an active member today, you would continue to put in contributions, your employer's going to pull those out, and then when you decide you're fully done in that position again, if you've worked less than 3 years more into retirement, we're going to refund all those contributions back to you and put you right back on that benefit amount that you were on before. If it's 3 years or more, we're going to recalculate your benefit with those new 3 years, or whatever, how many years it happens to be, and you'll end up with a higher monthly benefit. So, okay? This is a very complex topic, working after retirement and all those options. So we do have a fact sheet out on our website that you guys can check out that gives you all the rules to it. But in a nutshell, 150-day break, make sure you observe that. And then beyond that, if you want to do more, just make sure you're limiting what your earnings are or doing the second benefit retirement option. So here's contact information for myself, for my other two benefit officers, Janelle, Margot, Lily, and our email addresses as well. Our fax number, our location in Helena. If you ever want to send us anything, those estimate of benefit letters could be mailed to that P.O. box. But yes, please call us if you guys have any questions on anything to do with your retirement. That's why we're there. I'm happy to answer any emails as well. If you can't call, a lot of times you guys are busy in the classroom, you can shoot me an email and I'll get back to you. Like I said, typically if I'm in the office and not traveling all over, I get back to you guys within that same day. I rarely will have any emails hanging out, so I'm fast to get back to you that way. So definitely take advantage of that. And yeah, so do you guys have any questions, any more questions for me that I can answer?